14 years combined, thousands managed at first, now hundreds of thousands. Every dollar of risk has taught us something books never could. Most people think trading only teaches you about the market. They're wrong. Trading teaches you about yourself, how you handle pain, how to make better decisions under pressure, and keep thinking logically when you're watching tens of thousands evaporate. In today's episode, Padma and I are sharing the brutal life lessons that only come from managing real capital, where real mistakes actually hurt. You'll discover why curiosity has become one of our biggest edges. We'll also reveal why being skeptical pays dividends when everyone else is optimistic, and how learning to make logical decisions while in pain separates winners from everyone else. These aren't just trading tips, these are hard-won principles we've learned over the years. Lessons you can only learn by putting real capital at risk and surviving what comes next. Let's dive into the life lessons trading has taught us over 14 years. Padma and I have been trading for 14 years combined. It has not only shaped our trading careers, it has changed our perspectives in our lives and how we live them. Here are the main life lessons trading has taught us, relevant both in trading and in life. Now, the first one I want to start off with is curiosity is the biggest edge. I have been probably speaking about this on Twitter for quite a long time now, and it's a very overused phrase, at least for me. However, it still remains one of the truest and phrase I probably live my life around. I try and allow and kind of breed that curiosity in all aspects of my life because I think that's often where you find the best opportunities. That's where you get to test and fail the most, which often leads you to find something that actually does work. And in trading, for me, the only way I've been able to progress is by having some of that curiosity. Now, it can be a double-edged sword in the sense that if you hop from strategy to strategy, it can cause issues in your own trading. But at least for me, once you have a nice balance of it, it has often just been the main way I've actually found any edge in the market.
Yeah, completely agree. It's like we were talking about it before we started recording, right? It's like one of the traits that you really need to have is like that relentless attitude towards something that like toward new edges and new ideas. Because even I think especially today, like when I started trading in 2017, maybe it was my lack of knowledge back then, but there was only a few places that were very common to trade, right? You were trading like micro cap equities. For a small trader, I mean, maybe you had some like CFD bucket shops that you could exploit, something like that. But nowadays you have so much stuff, especially in crypto markets, for example. You have all these markets now going into the prediction market business. You have exchanges popping up out of nowhere, decentralized exchanges. All of these brings us so much like dispersion of capital and opportunities that come up. Like if you have a relentless attitude and you understand that, you understand how to go after certain ideas, like and if you have patience, like to actually dig into the documentation and understand how these things work, like that's a super edge, just being interested.
Yeah, completely. Do you want to kind of ping pong back and forth? So I guess you can do your first one now.
Yeah, for sure. So my first one is like most things that make money in markets are already discovered. And if you think you discovered something new, like a new edge or a new trade, whatever, my bet is always on two things. Either you don't understand what really is that you are extracting from the market, or you made a mistake somewhere. Okay? Because if you're using data that is available to everyone, and most certainly I think that you are, it will be very hard for you to find something unique like a big edge that you found on price data. That doesn't exist, right? You either don't understand what it is, so you are taking risks that you don't understand, that other people don't want to take, and that's why you still get paid for it on the historical data, or you made a mistake somewhere in your backtesting process.
Yeah, I think I would agree in a systematic sense. I think it's obviously a bit unclear when you're kind of like including discretionary bets. Sometimes that can be like a lagging thing that you're maybe pricing in something that's more in the future. Like I was just kind of thinking of Chris Camello when that kind of came up. Where we actually talked about him on a previous podcast where he kind of used like sentiment and just general intuition of how things look for predicting earnings and things like that. But I do agree, if you're going through like data mining or something and you think you've actually discovered a genuine alpha from that, most of the time, unless you are trading a very inefficient and very new market, it's most likely already been discovered multiple times, and it's probably then a risk premium that you're kind of taking advantage of.
No, yeah. For example, that example that you just gave of Chris Camillo, I mean, those type of ideas cannot be back tested, right? They are
Yeah.
they are alpha, I could say. So I'm not talking really about those. It's just stuff for people that are doing like data mining or backtests and stuff like that. If you think you found something new on a backtest, you are wrong.
Yeah, completely. All right, my next one is sample size is king. Don't make changes based on a small occurrence unless it affects something really important like risk management or a stress event. And this also applies in life. Like right now, I try and only have an opinion on something that I have enough data on. Obviously, I can have a subjective opinion, and etc. But if I want to have something where I have a strong conviction against it, I want a decent amount of sample size. And this obviously has just come from my trading with knowing how often people make decisions based on two bad trades and then they change the whole strategy, or they add a new thing to the strategy just because of that one losing trade that was just a normal loser, but they wanted to add something else to try and prevent more losses. And over time, that's just only led to one thing, which is overfitting, and then strategy is no longer working. The only nuance or exceptions to that is, if it's something like a stress event happens and you haven't actually properly done your volatility targeting or whatever X thing you're using, then obviously, yeah, make that change, implement it quickly because you've suffered probably a loss from that, and then learn and learn from that mistake. But a lot of trading is just taking a lot of losses and kind of continue going on.
Yeah, for sure. There's no way around it. And it actually kind of merged quite well with my second topic, which is like risk is never eliminated, always shifted somewhere else. So when people go into their back test and start tinkering with the data and start, oh, I took a big loss here. Can I like add the moving average here? And so I would avoid having this position. When you start going down that route, it's really tricky. You are not eliminating risk. Trust me when I say it. You are just shifting somewhere you don't see it. And in markets, you usually, in my experience, you want to keep risks as apparent as possible. You don't want to throw them under a rug. So if you take a big loss there, when I say big, it's like, I'm not saying you took too much size in a model. You are not doing that, right? I'm just saying if you see that that's an obvious loss, but you cannot remove that loss without tinkering with the model a lot, like adding new features on top of it, filters and stuff like that, I would still take the loss because I know that's the risk. That risk is apparent to me. I know that it's there. I know that in the future I'm going to take a similar loss again, and I can accept it and know about it and adjust my position size for it. But if I'm going to start adding a bunch of different filters, I'm now shifting the risk that I previously had and knew about it and was happy to have it. Now I'm shifting it to the model being overfitted or whatever it is that I'm shifting it towards. And I usually tend to prefer to always keep my risk very apparent to me.
I think that's so well put. I know it's not exactly the example you're speaking of, but the one thing that just came to mind when I was listening to that was primarily that I remember in small caps, like the larger you made your stop loss, right, it just felt like you were eliminating more risk because you were controlling your risk up to that amount of stop loss size. But then you weren't counting in things like halts that could just completely overshoot you. And if you already have a really large stop loss, by that time it's like a really, really damaging loss. So like those sort of things, you're shifting risk in ways that you can't see it yet, or you haven't back tested for it, etc. My next one is sort of similar, I guess. It's never about the next trade, but it's about the next 100 or 1,000. And this primarily is just a lesson about repetition and not caring about the next rep and just caring about, doing it 100 times, 1,000 times, etc. Especially for me, I still find it in myself sometimes is that I pay way too much attention to one particular trade. Now, obviously, I have the benefit of automation, so I'm not always looking at trades. But for example, if I ever put on, like we did with a SPY trade, etc., sometimes I have too much attention to that one trade. I can feel it when I have a discretionary position on. I have less focus in other things. I'm always kind of checking that one position if I do have that discretionary position on. And I think that's one thing I'm still, not, I wouldn't say struggling with, but it's still a battle every day that when you do have a position, especially if you're putting on decent size, it can be a thing that encapsulates your mind and ruins other areas. But in reality, it never matters about that, one next trade result. It's about the next 100 or 1,000.
Completely agree. If I may add something there, it's like a picture that you are playing with your friend a game of coin, right? A coin flip game. And you have a 5% edge over your friend. Okay. So let's say that you do 10 flips and you lose money on those 10 flips. Do you quit the game? No. Like you have 5% edge. You should play that game as much as possible with for as long as possible, as long as you can, right? Same with trading. If you truly have an edge, you have positive expectancy behind your decisions, like you should keep playing that game. And it doesn't matter one trade or two. but we are humans, right? And sometimes it will affect us, and that's fine. Your actions is what dictates if it's a bad decision or not. The next one that I have is that abnormal returns are usually derived from taking abnormal amounts of risk, and this is an idea that how can I put it? Like, you see a lot of traders on Twitter, for example, or YouTube or whatever, show these equity curve. Let's assume they are real. Let's assume that they are not fake, and they are trading usually the S&P 500, or they're trading equities or whatever. Let's say. What you don't, and sometimes they are beating the. Sometimes no, when these people share, they are usually beating the benchmarks, right? What you don't see there is where are those returns coming from? How much leverage did they use to achieve that? Because I can go right now and put my entire portfolio on a leverage ETF, or just a 2x leverage SPY position or something like that, and I will double the SPY performance, the absolute performance. But am I really beating the benchmark? No. No one serious thinks like that. Like, everyone can go now and just leverage trade whatever, and you'll beat the benchmark. But the problem is that you are adding a lot of risk. You are increasing your beta by 2, and you are adding a lot of market risk. So if the market goes down by 50%, you blow up your account, right? Because you are leveraged 2 to 1. So these traders, when they show overperformance over a benchmark, they never show you how much are their risk-adjusted returns, and that's what matters. It's like, okay, for the same unit of risk that I took here on SPY, like on a buy and hold, how much return did I get on my portfolio for the same unit of risk adjusted to volatility, to the leverage and everything else, right? That's what matters, because everyone can trade with leverage and make more money than the benchmark. That's not hard in a bull market. What matters is risk-adjusted returns.
I completely agree. And I also think one thing that's super important about this, especially when people see it online, is this is nothing to take away from some of the best traders I know. And it's definitely not all of them, but it's also a decent amount of people that post kind of screenshots and stuff on Twitter, is that sometimes those people have taken on abnormal amounts of risk. They've leveraged up a ton, and the outcome has been successful. And then automatically people assume, well, oh, okay, like it was just such a good trade. He made all his money like doing this really well, a high edge strategy or something. But realistically, it's just the outcome of a lucky sequence of trades, which, nothing to take away from them. They took on that risk and it paid off. But there's also probably hundreds of cases where someone has put on X amount of leverage and risk and it's not paid off in that way. So it's basically just survivorship bias in that sense, where you do always have to be a bit careful and keep that in mind, especially when you're seeing someone, turn 35,000 to 10 million or something, in like a year. Like, that is a crazy amount of risk to do that. So just keep that in mind.
That makes complete sense, and even people, so that people don't discard as well the ones that actually post long-term performance, let's say a 2 or 3 year performance. Even those performance that are more long-term, even those you don't really know, like the risk exposure that they had, they could have a lot of leverage exposure and just be leverage, what is called in the traditional terms, like leverage beta. It's like you just leveraged your market exposure, and that's it.
Completely. My next one is a lot of life is learning how to deal with pain while still making logical decisions. This probably has been my biggest takeaway from the past couple of years, is that especially as trading more size, where size matters now, in the sense where it's not something I could just, go out in a job and recoup it in like a month or two, right? It's a different level, I would say, of maybe stress or even just mental fortitude to kind of go through, especially when you're pushing size or you're taking a decent amount of volatility. And a lot of it this year has just been, I guess it sounds really stupid, but like a lot of days, especially if I've had like a bad day, maybe with automation, the last thing I want to do is touch that automation, and I have to somehow just get through the day knowing that I've lost X amount and I have to be fine with it. And, that has come from doing distractions, having other hobbies outside of trading, working with other traders. Like, I'll complain to you, and like, I don't know, it just relieves a bit of that stress. Like, all that sort of things, I think, is a really good way of just being able to push through. And that's been the biggest lesson, I would say, or one of the biggest lessons from recent years, at least.
Yeah, definitely. And I think this year has been like one of those years, right?
Yeah, for sure.
Yeah. So the next one is like work on signal research from an ideas first perspective. And this is something that we talk a lot about here, right? It's like we talk with a lot of traders on our socials and stuff like that. And there's always this tendency towards going, especially more on the engineering types, into going into stuff like machine learning and trying to data mine everything. And because it does, if we think about it logically, like it makes sense, right? If you put a machine learning algo going through a bunch of data, you'll get a bunch more information fast, right? But the problem is that market data it doesn't work like that. And if you beat the data long enough, like if you beat it long enough, it will tell you whatever you want. And like we talk a lot about like statistical relationships in markets break all the time. Things that worked in the past doesn't anymore. And you can find all of these sort of ideas in past data that it won't work going forward. So you need to, our approach is we think from an effect or behavioral, whatever you want to call it, idea first. Why is someone wrong? Why is someone overpaying or underpaying for this exposure that I can take? Why is someone making a mistake? Why am I taking a risk that others don't want? Why do they don't want that risk? And why should I get paid for it? Thinking about that in these ways, 80%, maybe 90% of my research process. It's just reading stuff and thinking about what is the other person on the other side of the computer doing. And then you develop the tools, what you call the models or the strategy to extract it, or at least to be able to extract it, basically. But the idea is first, the idea is first there.
I couldn't agree more. And I also think this is why like we both get on so well and also we work together so well, is because like we have a very similar philosophy around this, or like at least from our experiences. Because I'm always surprised, especially if I ever do like consultations or whatever, or even just free calls or whatever. Like there's a lot of people out there that I think truly believe machine learning is like just a better method to it, and like will achieve, and you'll be able to find alpha through it. And while yes, the best and biggest hedge funds are using that technique and completely on a retail level, it is so difficult to get that to fully work without overfitting or just running into other sort of errors. And I do think it's a bit of one of those, I can't remember the name of that bias, but it's where like you think you'll be the smarter one than everyone else, right? Like you hear everyone else say the same thing, that machine learning is really difficult to do for generating signals, etc. And you think, well, I'll be the person that can do it, or I'll be able to find the tech that can do it. Yeah. And I think the only thing that really teaches most people of this is like you have to just go through it and then realize that okay, this is actually a very difficult game to compete at, and then you work on more stuff like ideas first, which has worked way better for both of us.
I was that guy once, actually, so.
Yeah, same. I think we all have to go through it. Cause like I've done machine learning things. I remember the one we talked about ages and ages ago was machine learning on like small cap volume at end of day or something like around those lines. I think it was you. And like those sort of things. I've tried all of it. It's very difficult. And now I even do like AI and machine learning stuff on SEC filings for Ask Edgar, and like that serves a really great purpose. But still, like there, I'm not generating signals or something. It's a very difficult thing to do.
Yeah, 100%.
My next one, which I guess is sort of getting into this as well, is that being skeptical pays dividends in trading. Now, I'll say this with a fine line, that some people maybe are a bit too skeptical. So both extremes isn't useful, but I would say on that 0 to 100, it pays more to be a bit more skeptical than the average. For the reason being is that a lot of models, a lot of trades, it's very difficult to first understand why they work, and two, if you're taking on other risks. And then on the backtesting side of things, it's very difficult to see if you've made the right assumptions before you've even gone live, all those sort of things. So it is better to be more conservative and skeptical in trading, and I've learned this throughout. I don't think there's ever really been a time in my trading where being overconfident has really paid me as much as being skeptical around stuff.
Yeah, no, completely agree. And listeners might be like thinking, oh, but isn't it like a contradiction to your first rule, like that curiosity is the biggest edge? Sure, but I don't think it's a contradiction at all. You must be curious. You must be always thinking new ideas, but you must do it from a skeptical perspective, because if you are too hopeful, you'll oversize positions that you shouldn't. You'll be too willing to take models that you didn't properly test. You got a really nice looking back test, but you got so happy about the back test rather than thinking why it should work. Like you should be skeptical. Like always, when you see something too good to be true, it probably is. and they're probably going to be the one paying the bill for that. And you should approach it with that mentality, yet be always curious.
Yeah, completely. Because it's one of those fine lines where, yeah, as you were kind of saying, it somewhat is a paradox, but in the other sense as well, if you're too skeptical or that you don't have enough of that curiosity, it leads to people where they'll only ever test historically and they'll never test something live, which is like you do need to get it live at some point. You want to do a bit of testing historically, obviously, you want to do decent modeling, but then you want to push it live, get it on live markets, start seeing results or etc. So that's why I think it's actually kind of perfect to have both of those on the list because they play well together.
Yeah, the curious skeptical, basically. And
Yeah, basically.
not to extend too much on this point, but I actually have a good story, and it is when I started trading. Actually, like I started microcap equities, and I never left the equities, microcap equities. I never explored like crypto, for example, in 2017 or later than that. Would have been amazing to do that. I never explored those places because I had this cult-like closed mentality that only microcaps worked. It sounds stupid now, but it is the reality. Like I was too skeptical to go anywhere else, and so I just focused on microcaps, even though I was not doing very well until 2019, and I could have done much better elsewhere. And I also closed my eyes, like my socials. I didn't have social media, anything. I just focused on the few people that were like my mentors, let's call that, and I just focused on whatever they said, and that closed me for so many years that I shouldn't. I should have just been the curious skeptical, like we were talking about.
Yeah, I think perfectly put.
Yeah, sure. So the next one we also talk a lot about is like competing in places where your skill set is at least slightly above the average competition. So if you are going for pure alpha plays or pure inefficiencies, whatever you want to call it, you're going to have to compete with other people that want the same thing, right? Because these are higher quality, more consistent type strategies, and everyone wants that. So, in order to do this, go into places where the average participant is a degenerate or something like this, like in prediction markets where people are completely insensitive um, to to actual like payoff ratios and stuff like that, and you can be a little bit better than them and provide that service to those markets and be you collecting that alpha there, because maybe there's only a 5 or 10 or $50,000 in liquidity there, and it's not very worth the time of someone trading a 7-figure book. So there's a bunch of places even now then that those behaviors are more like apparent, basically.
Yeah, perfect. I think you summed that one perfectly. For my last one, it's going to be knowing your objectives in trading and motivations will only make you a better trader and not just looking for returns. The reason I say this is because the more we've gone over different strategies, I've tested different strategies, I've seen different people trade. Most of the time, everyone else has a slightly different motivation. And I think this leads back to kind of your risk tolerance and risk personality. And I think it's worthwhile to sit down with yourself, maybe one evening, etc., at different stages of your career and ask, what is my main focus right now? Do you want to, protect your capital a bit more? Are you fine having tail risk and maybe blowing up, but then maybe having a lucky sequence of trades to kind of grow your account? Because while that isn't a good practice when you're using a big account, when I had my first small account in small caps, I definitely was taking on a decent amount of risk. I was leveraged up, and like I did have a strategy at edge, but I tried to exploit as much as possible, knowing that I had a small account. I could go to work and like make back that money. It wasn't anything that was gonna deter me from life or anything like that. So having a conversation about what your objectives are and then your risk tolerance on each part of your career, I think has been a very valuable conversation for myself, because I definitely trade a lot differently than I ever would, starting out again.
Yeah, and I do like this is a wishy-washy conversation, like it's we're not trying to make it like a psychology type thing, but like, and just if you come to this business just to make money, we all want to make money, right? But if you just come, oh, I want to make money quick, I want to be rich, I want to trade from a laptop from the beach, like that's not a real goal. Like you
Yeah.
have to be truly interested about this space. You're not going to cut it that way. So I truly believe that having reality checkups, being really interested in what you're doing, and sure, being compensated for it. Everyone does this for the money, of course. My last one is focusing on what you can do to make money today and not on future potential problems. This is a common phrase from Robot James, and is something that's stuck with me forever. It's like sometimes we go down these like engineering missions, right? Hey, I wanna study the correlations behind like all the coins that I trade and allocate my size with the right correlations, like my size dictated by the correlation. Like you go into really nerdy, like complex topics that sometimes you don't fully grasp the entire risk there and what goes on the back end. And at the same time, a guy running a simple momentum model on meme coins and meme coin trenches are hot, are making more money than you would like at a job for 10 years. You know, like what can you do today, like with the simplest possible variation to make money, and then go from there. I'm not saying don't improve, don't try new stuff. I'm just saying focus on what you can do today. Like the market will pass you, like a good market, a good bull market or bear market or momentum period, whatever you want to capture. Like that stuff will pass in the future. If you're not there in today and you are trying to solve for future problems, yeah, you're not getting that exposure and experience that is much more valuable than trying to improve your returns by 5% a year.
I think I'll end it off on a story that works perfectly with this, because I'll say from my personal experience, I've always been on the other side of that, right? I've probably always jumped the gun with things, either with size or whatever, like trying to take trades, etc. But I did meet a trader that I had a brief conversation with him, and I asked him like, how long has he been trading? And he said about 3 years. And I was like, oh, that's awesome. Like, what sort of strategies do you run? And that kind of led down the conversation where he basically said he'd been simulated trading with like models. He'd been a software engineer before, and he'd been coding quite well, but he had just continuously tested new strategies on simulator. He'd never put anything live because he was always, I think it was a nervousness around actually getting it live and seeing if results worked. And then also about the idea that a lot of, especially if you're from a software engineering background, a lot of the fun is the tinkering, right? Like it's not that much fun to put risk on. It depends on your personality. For me, it does become a bit fun, but for a lot of people, it seems like you are necessarily kind of scared away from that because you don't want to have that kind of final outcome where you could lose a bit of money. And I think in trading, as you're sort of saying, you do need to focus on what's possible now and trying to push yourself to get out there, and especially not trying to wait for some picture perfect strategy or picture perfect infrastructure that you've created. It's totally fine to get out there and lose a bit of money, and you'll often learn way more than whatever money you've lost, as long as you're keeping it sensible.
And one of the realizations that I made over the years is that the times that I was most hesitant was never about risk. Like I'm not a risk averse person, you know that. I sometimes take too much risk, but one of the realizations I've had over the years is that when I hesitated to take a model live or to put something in the market, it was never about that risk. It was about me being afraid, like being scared that all the work I've done was for nothing and that I was not as smart as I thought I was.